What if a decision made in Tokyo quietly starts impacting your 401k in America? Most Americans checking their retirement account balances never think about Japan. Why would they? Their 401k is invested in American companies, American bonds, the American economy. Japan feels distant, disconnected, irrelevant to their financial future. But here's what those Americans don't know. Japan is the world's third largest economy. Japan holds $1.13 trillion in U.S. Treasury securities, making it the largest foreign holder of American government debt. Japan is a key player in global interest rate flows, currency markets, and the intricate web of capital that connects every major economy on Earth. When Japan adjusts interest rates or shifts its monetary policy, the effects ripple across the Pacific Ocean. U.S. mortgage rates feel it, stock valuations adjust, the tech sector responds, and yes, retirement funds, those 401k accounts that millions of Americans depend on for their future security, feel the impact. Right now, Japan is undergoing a fundamental economic shift that most Americans haven't heard about. The Bank of Japan raised interest rates to 0.50% in late January, the highest level in 17 years. This represents a dramatic departure from decades of near zero or negative interest rates. Bank of Japan Policy Board member Kazuyuki Masu told Nikkei on November 22nd that the central bank is nearing a decision to raise interest rates, with mounting speculation about additional hikes at December or January meetings. This isn't just Japanese monetary policy. This is a seismic shift in global finance with direct implications for American workers, savers, and retirees. Most Americans have no idea how interconnected their retirement money is to Japan's economic decisions. The connections aren't obvious. They're not explained in 401k statements or financial news headlines, but they're absolutely real. Today, we break down with real data, no hype, how Japan's latest economic shift could influence your investments, your retirement, and the U.S. markets in 2026. Because understanding these connections isn't just interesting economics. It's essential financial literacy for anyone with money invested in American markets. To understand the potential impact on American retirement accounts, we first need to grasp exactly what's happening in Japan and why it represents such a dramatic change. For more than a decade, Japan maintained ultra-loose monetary policy. The Bank of Japan kept interest rates at zero or negative, purchased massive quantities of government bonds to suppress yields, and essentially flooded the financial system with cheap money. This was deliberate policy designed to combat deflation and stimulate an economy that had struggled with stagnation since the 1990s. But 2025 marked a turning point. The Bank of Japan raised its key interest rate to 0.50%, citing increased likelihood of achieving the central bank's price target in a sustainable and stable manner. This followed an earlier move in March 2024 when Japan raised short-term interest rates for the first time in 17 years, ending its negative interest rate policy. The yen experienced significant volatility throughout 2025, strengthening against the dollar after years of weakness. Currency markets responded to changing interest rate differentials between Japan and other major economies, creating uncertainty for multinational corporations and investors with cross-border exposure. Japanese government bond yields rose to levels not seen in years. The 10-year yield climbed well above 1%, and longer-dated bonds showed even more dramatic increases. For a country accustomed to near-zero yields, this represents fundamental repricing of domestic debt. Perhaps most significantly for American investors, Japan's total holdings of U.S. Treasury bonds stood at $1,189.30 billion as of September 2025. While Japan remains the largest foreign holder of U.S. debt, there have been periods of selling. Preliminary data from Japan's Ministry of Finance recorded long-term foreign bond sales worth $17.5 billion in the week ending April 4th, 2025, along with an additional $3.6 billion the following week, coinciding with market volatility and bond yield spikes. What does economic normalization mean in plain English? It means Japan is transitioning from crisis-era policies to more normal monetary conditions. Interest rates moving from negative or zero toward positive levels, bond yields rising from suppressed levels toward market rates, currency values adjusting as interest rate differentials change. This is all part of Japan moving away from the extraordinary measures it implemented to fight deflation and toward policies more typical of a healthy economy. But here's the critical point. When the world's third largest economy and one of the largest holders of U.S. debt fundamentally changes its monetary policy stance, the ripples spread globally, capital flows shift, investment returns recalibrate, markets adjust. And American retirement accounts deeply connected to these global financial flows, whether their owners realize it or not, feel the effects. The connection between Japanese monetary policy and American retirement accounts operates through several distinct but interconnected channels. Understanding these mechanisms is crucial for grasping why events in Tokyo matter in Ohio, Texas, and Florida. Start with the most direct connection: Japan as a major buyer of U.S. Treasury securities. Japan holds $1.13 trillion in U.S. Treasury securities as of February 2025, representing the single largest foreign holder position. For decades, Japanese institutions, banks, insurance companies, pension funds, individual investors bought U.S. Treasuries because they offered positive yields, while Japanese bonds offered essentially nothing. This massive, continuous demand from Japan helped keep U.S. Treasury yields lower than they otherwise would be. More buyers means higher prices, which means lower yields. When Japan's demand for U.S. Treasuries changes, either buying less or actively selling, it affects the supply-demand balance in the U.S. bond market. Fewer buyers means lower prices, which means higher yields. Higher U.S. Treasury yields ripple through the entire American economy. Mortgage rates are benchmarked to Treasury yields, so when Treasuries yield more, mortgage rates rise. Corporate borrowing costs increase because corporate bonds must offer yields above Treasuries to attract buyers. Municipal bonds adjust. Every interest rate in America is ultimately connected to Treasury yields, which are influenced by Japan's buying or selling decisions. When Japan adjusts its own interest rates upward, capital flows shift fundamentally. If Japanese bonds suddenly yield 0.5%, 1%, or higher, Japanese investors face a different calculation. Why accept the currency risk and complexity of buying U.S. Treasuries yielding 4% when domestic Japanese bonds yield 1% with no currency risk? The spread narrows, the incentive diminishes, the capital flow changes direction. A stronger yen, which typically accompanies rising Japanese interest rates, creates additional effects. Japanese institutions holding U.S. assets face currency translation issues. If you're a Japanese pension fund holding U.S. Treasuries, and the yen strengthens 10%, your dollar-denominated assets just became 10% less valuable in yen terms. This creates incentive to reduce U.S. holdings and bring capital home. For Americans, these dynamics translate directly to everyday financial realities. Higher U.S. Treasury yields mean mortgage rates adjust upward. A family trying to refinance finds rates haven't come down as expected. A couple buying their first home faces higher monthly payments. A business looking to expand confronts elevated borrowing costs. Tech stocks and growth companies are particularly sensitive to interest rate movements. These companies are often valued based on future earnings, discounted to present value. When interest rates rise, those future earnings become less valuable in today's dollars, so stock prices adjust downward. This is why tech-heavy indexes often react sharply to interest rate changes. Changes influenced by global capital flows, including Japan's decisions. For the millions of Americans with 401k accounts holding technology stocks, this connection matters directly. When Japanese monetary policy shifts cause U.S. interest rates to adjust, tech valuations respond, and retirement account balances reflect those changes. U.S. pension funds, including corporate pension plans and public employee retirement systems, are deeply connected to global capital flows. These institutions invest across multiple asset classes: domestic stocks, international stocks, bonds, alternatives, all of which respond to shifts in global interest rates and capital movements. When Japan, as one of the world's largest capital exporters, changes its investment patterns, it affects the returns these pension funds earn. The key takeaway is this: global capital markets are interconnected. What happens in Tokyo doesn't stay in Tokyo. Japan's transition from ultra-loose monetary policy to normalization represents a fundamental shift in how one of the world's largest pools of capital gets allocated. American investors, whether they realize it or not, are exposed to these shifts through their retirement accounts, their mortgages, their stock holdings, and the broader U.S. economy's financing costs. Let's break down the specific ways Japanese economic shifts could affect American retirement accounts. This isn't speculation or fear-mongering. This is explaining the actual mechanisms through which global capital flows affect domestic investment returns. Many 401k plans hold U.S. Treasury bonds either directly or through bond funds. These are considered safe, stable investments appropriate for workers approaching retirement or anyone seeking lower-risk portfolio components. A typical target date fund for someone retiring in 2030 might hold 40 to 50% in bonds, with significant Treasury exposure. When Japanese institutions reduce purchases of U.S. Treasuries, either buying less than before or actively selling holdings, it creates upward pressure on Treasury yields. Remember, bond prices and yields move inversely. Higher yields mean lower prices for existing bonds. If your 401k holds Treasury bonds or Treasury bond funds and yields rise due to reduced Japanese demand, the value of those holdings declines. This doesn't mean your bonds become worthless. It means they're worth less than they were before yields rose. For someone planning to retire soon and counting on stable bond values, this matters. The safe part of their portfolio experiences losses they didn't expect and may not understand. Different sectors of the stock market have different sensitivity to interest rate changes. Technology companies, growth stocks, real estate investment trusts, these tend to be highly rate sensitive. When rates rise, their valuations come under pressure. Many 401k plans are heavily weighted toward large cap US stocks, with significant exposure to technology. The S&P 500, the most common benchmark for 401k investments, has substantial tech weighting. When Japanese monetary policy shifts contribute to rising US interest rates, tech stocks often lead the decline. Consumer sentiment and corporate earnings also respond to interest rate environments. Higher rates mean higher borrowing costs for businesses, which can squeeze profit margins and reduce earnings growth. Slower earnings growth typically means lower stock valuations. Again, 401k balances reflect these valuation changes. Many 401k plans offer international stock funds, and some include specific Japan funds or Asia-Pacific funds. These give Americans direct exposure to Japanese markets and currency movements. When the yen strengthens or weakens significantly, it affects the dollar value of Japanese stock holdings. A Japan fund might see its underlying Japanese stocks rise in yen terms, but if the yen weakens against the dollar, American investors might not benefit or could even lose money. Currency fluctuations add a layer of volatility that many 401k participants don't fully understand. Global emerging market funds also respond to Japanese monetary policy shifts because Japan is often grouped with other Asian economies in portfolio allocations, and capital flows in and out of the region respond to Japanese interest rate changes. Perhaps the most consequential impact isn't about specific asset classes, but about overall volatility and how it affects retirement planning. When 401k balances fluctuate due to global events most Americans don't understand, it creates anxiety and potentially poor decision-making. A worker in their 50s, watching their retirement balance drop 10% due to bond and stock market volatility, might panic and shift to cash, locking in losses, and missing subsequent recovery. The timing of retirement becomes more fraught when account values are volatile. Someone planning to retire at 65 might need to work to 67 if their 401k balance falls at exactly the wrong time. Dollar strength or weakness, driven partly by interest rate differentials with Japan, affects international holdings in 401k accounts. A stronger dollar makes foreign investments less valuable in dollar terms. A weaker dollar does the opposite. These currency effects can meaningfully impact returns for internationally diversified portfolios. The fundamental reality is this: 401k accounts aren't isolated from global economic forces. They're deeply embedded in global capital markets. When major shifts occur in how the world's third largest economy manages monetary policy and allocates its enormous capital reserves, American retirement accounts feel the effects through multiple channels simultaneously. To make these abstract mechanisms tangible, consider how they might affect real Americans in recognizable situations. Picture Sarah, a 52-year-old school teacher in Ohio. She's been diligently contributing to her 403b, essentially a 401k for public educators, for 25 years. She plans to retire at 62, giving her a decade to enjoy retirement before Medicare age. She checks her account quarterly, watching the balance grow steadily over the years. In late 2025, she notices something unusual. Her account balance, which had been climbing steadily, suddenly shows unexpected fluctuations. One quarter it's down 4% despite no major domestic news. The next quarter it's up 3%, then down again. The volatility confuses her because US economic news seemed relatively stable during these swings. What Sarah doesn't realize is that her target date 2035 fund holds significant US Treasury bond exposure, which experienced price declines as Japanese buying patterns shifted and yields rose. The fund also has international stock exposure, including Japan and Asia Pacific funds, which experienced volatility as the yen strengthened and weakened through the year. These global forces, invisible to Sarah, are affecting her retirement timeline and causing stress she never expected. Or consider Marcus, a 43-year-old warehouse worker in Nevada. His 401k is invested primarily in a balanced fund that his company automatically enrolled him in. He doesn't check it often, maybe once or twice a year, because he doesn't really understand investing and trusts that the fund managers know what they're doing. When he does check his account in November 2025, he's surprised to see his balance hasn't grown much despite his regular contributions all year. In fact, returns are nearly flat. He's confused because he keeps hearing about stock markets near all-time highs, yet his retirement account isn't reflecting those gains. Marcus doesn't know that his balanced fund holds both stocks and bonds. and that the bond portion experienced losses as interest rates adjusted, partly due to changing Japanese capital flows. The stock portion did well in some sectors, but poorly in others, with rate-sensitive growth stocks underperforming due to higher yields. The net result is a year of disappointing returns that Marcus can't explain, and that frustrate his retirement planning. Think about Robert and Linda, a couple in their late 60s in Florida who retired 2 years ago. They spent decades building their retirement savings and thought they had enough to maintain their lifestyle. Their retirement accounts are conservatively invested, mostly bonds and dividend-paying stocks, to preserve capital and generate income. In 2025, they're noticing their quarterly statements show declining values despite the conservative positioning. Their bond holdings lost value as yields rose. Their dividend stocks in rate-sensitive sectors like real estate investment trusts and utilities declined. They're not panicking, but they're concerned. They thought conservative investing meant stable values, and the volatility they're experiencing doesn't match their expectations. What they don't realize is that even conservative portfolios are exposed to global interest rate movements. When Japan shifts monetary policy and affects U.S. Treasury yields, it impacts bond portfolios regardless of how conservative the investment strategy. The interconnected nature of global finance means no investment is entirely insulated from major shifts in how the world's largest economies manage money. These stories aren't extreme scenarios. They're realistic illustrations of how abstract economic forces translate into real impacts on real Americans' financial lives and retirement security. For financial professionals and economists tracking these dynamics, several specific indicators provide insight into how Japanese monetary policy is affecting U.S. markets, and by extension, American retirement accounts. Japanese 10-year government bond yields serve as a key benchmark. When these yields rise, it signals that Japanese domestic bonds are becoming more attractive relative to foreign alternatives. Experts watch not just the level, but the trend and volatility. Steady, gradual increases suggest orderly normalization. Sharp, volatile movements suggest market stress and potential disruption to capital flows. Bank of Japan policy statements receive intense scrutiny. Governor Kazuo Ueda emphasized a flexible, data-driven approach, stating that rate hikes will depend on whether underlying inflation is likely to sustainably reach the 2% target. Every word matters because it signals future policy direction, which markets price in immediately. U.S. Treasury yields are monitored continuously for signs of Japanese influence. When 10-year Treasury yields spike without corresponding changes in U.S. economic data, analysts look for evidence of foreign selling, potentially from Japan. The relationship between Japanese buying patterns and U.S. yield movements is closely tracked. The dollar-yen exchange rate, USD/JPY, provides real-time indication of capital flow shifts. Sharp yen strengthening often accompanies periods when Japanese capital is flowing home rather than overseas. Yen weakening suggests the opposite. The volatility of this exchange rate indicates the degree of uncertainty and adjustment occurring in global capital allocation. Large institutional fund flows are tracked through various data sources. When major Japanese pension funds, insurance companies, or banks adjust their U.S. asset holdings, it shows up in flow data that experts analyze for trends and implications. Corporate earnings guidance referencing Asia becomes more important during periods of Japanese monetary policy transition. When American companies with significant Japanese operations or exposure to yen currency movements discuss these factors in earnings calls, it provides ground-level evidence of how policy shifts are affecting real business operations. Federal Reserve meeting expectations adjust based partly on global interest rate dynamics. The Fed must consider how foreign capital flows affect U.S. financial conditions when setting domestic policy. If Japanese demand for treasuries wanes and yields rise, it effectively tightens financial conditions without the Fed taking action, potentially influencing their policy decisions. Each indicator tells part of the story. Together, they create a comprehensive picture of how Japan's economic normalization is affecting global capital markets and, ultimately, American investors' portfolios. Rather than predicting what will happen, let's examine plausible scenarios for how Japanese monetary policy evolution could affect American retirement accounts over the coming year. In this optimistic case, the Bank of Japan continues tightening monetary policy gradually and predictably. Rate increases come slowly, perhaps one small hike every 6 months, giving markets ample time to adjust. Communication from BOJ officials is clear and well telegraphed, minimizing surprises. Japanese institutions reduce their U.S. Treasury holdings gradually, selling small amounts or simply buying less than before rather than dumping large positions. Other buyers, domestic U.S. investors, other foreign countries, step in to absorb what Japan isn't buying. U.S. Treasury yields rise modestly but not dramatically, perhaps 20 to 30 basis points over the year. U.S. markets adapt to this new equilibrium. Stock prices adjust to reflect higher discount rates, but corporate earnings remain solid enough to support valuations. Bonds experience modest price declines as yields rise, but nothing catastrophic. For 401k holders, this scenario means minor volatility and possibly flat to slightly negative returns for the year, but nothing that derails long-term retirement plans. Workers approaching retirement might need to work an extra year or adjust spending slightly, but no dramatic changes required. In this middle scenario, Japanese monetary policy normalization proceeds less smoothly. Perhaps the Bank of Japan hikes rates more aggressively than markets expect. More communication creates uncertainty about the policy path. The yen experiences sharp movements, strengthening or weakening 10 to 15% over several months before stabilizing. U.S. Treasury yields fluctuate more dramatically, moving up 50 to 70 basis points with significant volatility along the way. Some weeks yields spike, other weeks they fall back. This creates uncertainty for all dollar-denominated assets and borrowing costs. Stock markets see sector rotation as investors move capital away from rate-sensitive growth stocks toward value stocks and sectors less affected by interest rates. Tech stocks underperform while financials, energy, and industrials potentially outperform. Overall market returns are modestly negative or slightly positive depending on portfolio composition. Retirement account balances reflect this volatility with ups and downs throughout the year. Target date funds experience swings. Balanced funds show uneven returns across their holdings. For 401k participants, this scenario means watching balances fluctuate more than they're accustomed to, creating anxiety even if year-end returns aren't terrible. Workers might delay retirement by a year or two waiting for accounts to recover. Those already retired might need to reduce spending slightly or draw down principal more than planned. In this more concerning but ultimately constructive scenario, global markets react sharply to Japan's policy shifts in the near term before stabilizing around a new equilibrium. Perhaps the Bank of Japan hikes more than expected, triggering a brief period of financial market stress. Treasury yields spike temporarily. Stock markets drop 10 to 15% over several weeks. Currency volatility intensifies. This creates temporary liquidity tightening as leveraged investors unwind positions and risk appetite declines across markets. Credit spreads widen. Volatility indexes surge. Financial news headlines scream crisis. But after this initial shock, markets stabilize. The new interest rate environment becomes the new normal. Japanese capital flows find a new equilibrium. U.S. Treasury yields settle at higher levels but stop rising. Stock markets recover as investors recognize that higher rates alone don't mean recession if the economy remains fundamentally sound. For 401k participants, this scenario means a gut-wrenching period of watching retirement balances drop, followed by gradual recovery. Those who panic and sell during the stress period lock in losses and miss the recovery. Those who stay invested recover losses and eventually benefit from the normalized, healthier interest rate environment. The key differentiator is emotional discipline, and understanding that short-term volatility doesn't necessarily mean long-term disaster. None of these scenarios are predictions. They're frameworks for thinking about how different paths could unfold and what they might mean for American retirement savers. The actual outcome will depend on countless variables: Japanese policy decisions, U.S. economic performance, global growth, geopolitical events, market psychology, and more. For individuals wanting to stay informed without becoming paralyzed by complexity, several accessible indicators provide useful insight into how these dynamics are unfolding. Watch U.S. Consumer Price Index reports and Federal Reserve policy statements. While these are domestic indicators, they interact with global capital flows. If inflation stays elevated despite slower growth, it limits the Fed's ability to cut rates, keeping U.S. yields higher and potentially affecting Japanese demand for treasuries. Monitor Japanese bond yields through financial news or websites. When you see reports about Japanese 10-year government bond yields, pay attention to the trend. Rising yields signal that Japan's monetary normalization is continuing. Stable or falling yields suggest pauses or reversals. The USD/JPY exchange rate is widely reported and easy to track. Sharp yen movements often indicate capital flow shifts. A strengthening yen, dollar weakening, lower USD/JPY number might signal money flowing back to Japan. A weakening yen suggests the opposite. Treasury market demand shows up in auction results reported by financial news outlets. When the U.S. Treasury sells new bonds, the demand and yields at those auctions indicate how strong global appetite is for U.S. debt. Weak auctions with high yields might suggest reduced foreign demand, potentially including Japan. Stock market sector rotations provide clues about interest rate sensitivities. If tech stocks are underperforming while financials and value stocks outperform, it often indicates interest rate concerns dominating market psychology. If growth stocks are leading, it suggests rate concerns are diminishing. Your own 401k quarterly statements deserve closer attention. Look beyond just the bottom line balance. Check how different fund components performed. Did bond funds lose value? Did international funds underperform? Understanding what's driving your returns helps you recognize when global forces like Japanese monetary policy are affecting your portfolio. Federal Reserve policy signals come through press conferences, meeting minutes, and official statements. When Fed officials discuss global financial conditions, foreign capital flows, or international interest rate dynamics, they're acknowledging that domestic policy doesn't operate in isolation from what's happening in Japan and elsewhere. Bringing all these threads together, what's the clear message American retirement savers need to understand? Japan's economy isn't collapsing. This isn't a crisis story. Japan is shifting from extraordinary crisis-era monetary policy toward more normal conditions. After decades of fighting deflation with negative interest rates and massive bond purchases, Japan is finally achieving stable inflation and can begin normalizing policy. This is actually a sign of economic health, not disaster. But because the world is interconnected, U.S. households feel ripples from this transition. Japan's role as the largest foreign holder of U.S. treasuries means their investment decisions affect American interest rates. Japan's position as the world's third largest economy means their monetary policy influences global capital flows. These ripples reach American retirement accounts through bond holdings, stock valuations, currency effects, and overall market volatility. However, ripples don't mean crisis. They mean adjustment. They mean transition. They mean the global financial system adapting to new conditions. For American 401k holders, this translates to potential volatility, possible flat or negative returns in some years, and the need for longer-term perspective on retirement planning. Your 401k depends on global economic health, not just domestic factors. Understanding this interconnection isn't cause for alarm. It's cause for awareness. When you recognize that global forces influence your retirement account, you're better positioned to understand fluctuations, avoid panic selling during temporary volatility, and maintain the long-term perspective necessary for successful retirement investing. The American economy remains fundamentally strong. Corporate earnings continue growing. The labor market, while cooling, remains relatively healthy. Innovation continues. These domestic strengths provide foundation for long-term investment returns regardless of short-term global adjustments. What matters most is maintaining realistic expectations. Retirement investing has never been a straight line upward. Volatility is normal. Global influences are increasingly important in our interconnected financial system. Japanese monetary policy normalization represents one of many factors affecting returns. Not the only factor, or necessarily the dominant factor. Stay informed, not anxious. Understand the connections, but don't let short-term volatility drive long-term decisions. Diversification across asset classes and geographies helps cushion individual shocks. Regular contributions during market dips can actually enhance long-term returns. Professional guidance from qualified financial advisors can help navigate complexity. The story of Japan's economic shift is still being written. How it ultimately affects American retirement accounts depends on execution speed, communication quality, market adaptability, and dozens of other variables. What's certain is that global interconnection means Americans benefit from understanding these dynamics, even if they can't control them. Thank you for investing time in understanding these complex but important connections between Japanese monetary policy and American retirement security. The financial world is more interconnected than ever before. Events in Tokyo, decisions in Beijing, policies in Frankfurt, all of these influence American investment returns and retirement planning. This isn't cause for concern. It's simply reality of modern global finance. The more Americans understand these connections, the better equipped they are to navigate volatility with confidence rather than fear. As Japan's monetary policy continues evolving through 2026, these dynamics will remain relevant for American investors. The Bank of Japan's decisions, Japanese capital flows, yen currency movements, all will continue affecting U.S. interest rates, stock valuations, and ultimately 401k balances. If you found this breakdown valuable, consider subscribing to stay informed as these trends develop. This channel brings real global economic analysis. No panic, no drama, just clear, data-driven coverage of developments that matter for American workers, families, and retirement savers. Understanding global economic connections doesn't require advanced degrees or professional expertise. It requires curiosity, attention to reliable sources, and willingness to see beyond domestic headlines to the broader forces shaping financial markets. Your retirement security matters. Understanding the global forces that influence it is part of being a financially literate citizen in an interconnected world. Thanks for watching, and we'll see you in the next breakdown.